My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to a special edition, a West Coast edition of Mad Money. Welcome to Cramerica. Other people want to make friends? Man, I'm just trying to save you some money. My job is not just to entertain, but to educate, to teach you, and to try to put this market in context, because I know it's awful. Call me at 1-800-743-CNBC or tweet me at Jim Cramer. On a day like today, where the Dow plunged 638 points. S&P plummeted 2.38%. NASDAQ nosedived 2.75%. All I can say is, come on, give us a reason why you're selling, will you? Did you borrow too much money and the margin butchers are booting you out to get the cash? Are you a hedge fund manager whose investors want their money back, a redemption? Maybe you just can't take it anymore, and that's why you're selling. I always say people sell stocks for many reasons, but the only reason they buy is to make money. Right now, the former camp is a lot more powerful than the latter. Sell. Buy! Now, after spending all week talking to the very same kinds of companies that led this horrendous market down, I got some good news and some bad news. Actually, though, it's the same news. The average Silicon Valley CEO I speak to, and I've probably spoken to 2 dozen this week, when asked about their plummeting stocks, say simply, why are you judging us on a quarter when we have such a positive long-term story? Now, that is a true statement. But the problem is the owners aren't patient. And if they keep buying on the way down, unless they are super rich, they will run out of money. It's easy for millionaire CEOs to talk about thinking long term. Regular investors can't afford to wait for the business to turn, though. In the end, people take the losses personally, or in many cases, they don't take the losses because they're hoping for the stocks to make a comeback. Unfortunately, that rarely happens, people. And even if it does, it probably takes much longer than you can stand. So what's the solution to this problem? Oh, but I lose sleep every night about this because I know how awful this market is. I wish I had an easy solution. But some days, nothing works. Days like today, where even the oils went down. Now, we had themeless trading. Some stocks were up, most stocks were down, with the winners almost totally random and arbitrary today. What is going on? I think we're in a period of the great readjustment, where investors are frantically trying to figure out what to pay for companies that aren't making that much money now, but may make a lot of money in the future. At the same time, they try to revalue companies that are making money now, but may make less money in the future because rates keep rising. Then, of course, there are the consistent companies that can make good money no matter what. But finding those is a treasure hunt game, and there's not enough treasure out there. And when you find it, the stocks are usually too expensive. For most of the last 12 years, we haven't had to navigate this kind of river. We've had a straight run, smooth run to higher and higher prices. It was placid. It was seamless. It was sweet. Most important, it was easy. Now we're plunging along Class 5 rapids, and we're glad we have helmets, because people falling out of the raft, bouncing off rocks, holding on for dear life, you need a helmet. Like Class 5 rapids, you don't know what's going to throw you. It's just not possible to see. So I want to dramatize for effect by just looking at one sector. I could have picked 20 of them. I want you to take a look at the stock Block. That's the company formerly known as Square. Until recently, the stock was a beautiful market darling that could do no wrong, including the purchase of a giant buy now, pay later company. And that was called Afterpay. That was an announced $29 billion deal last August. The actual purchase price was lower because it was an all-stock deal, and Block shares collapsed between when the deal was announced and when it was closed. But at the time it was announced, it was hailed as like just a brilliant deal. And the stock roared just on the possibility of an acquisition in that red-hot buy now, pay later area. So this thing went from $200 last June to above $280 in August. We were told younger people love the concept of buy now, pay later, so we should buy the stock. But as interest rates rise, we're now seeing the cracks in that credit edifice. You know the cliche joke, buy now, pay never. The old Square had been very adept at letting small businesses borrow money against the receipts because Square itself was processing those transactions. But buy now, pay later doesn't have that kind of collateral. Next thing you know, the market turns on the fintech stocks and Block takes a beating. This thing was down another 9% today for 76. It's down 76 bucks. So much for a brilliant acquisition. But I got really bad news for you. Nothing happened to Block today. Nothing. And it went down that much. Affirm. Another buy now, pay later operation. We just had on Max Levchin, the CEO. It's seen its stock go from 168 at the peak last November to $21 and change here, down another 9% today. Not long ago, CEO Max told us that his default rate is incredibly low. He said he can repackage those loans and sell them with ease. The Wall Street Journal just reported that 3.7% of a firm's loans are at least 30 days overdue, up from only 1.4% a year ago. Now, that's freaking people out for good reason, even as though it's not necessarily all that different from the reassurance Max gave us. But the market is saying, so what? There's credit risk? I didn't think there was credit risk. Get me the hell out of this thing. Last fall, we spoke to Dan Schulman, the CEO of PayPal. When he came to New York, his stock had fallen from the 180s down from the 300s a few months before. He seemed exasperated that stocks like Affirm and Square their stocks were doing much better than him. So what did he do? He claimed proudly that PayPal was the biggest player in buy now, pay later. Well, Schulman sure got his wish, but it's a monkey's paw situation because Wall Street now hates buy now, pay later. One reason PayPal stock has plunged another $100 since that interview. Now, I don't want to pick on any one particular group because so many things are crumbling here. I'm just trying to show you how when you buy stocks of companies that are expensive with no dividend protection, low interest rate environment, you're going to keep getting blasted until the Fed is finished raising rates. Probably not anytime soon. Tightening cycle just started. The market is littered with stocks like this. We have Uber on today. Oh, that's a great company. I know you use it all the time. Stock's been cut in half. Just in the last year. Why? A year ago, it would be up on the same metrics. This stock would have doubled. Now it's cut in half. A year ago, it was in style in the Wall Street fashion show, and now it's not. I think it will be the big winner in the group. But do you have enough money to get to that promised land where it wins? You have to if you're going to own it. Two of the companies out here that are hailed as huge success stories. Airbnb, love it. DoorDash, use it. They plummeted 6.5% and 7% today, respectively. Why? No reason at all. They just happen to be growth stocks that have nothing to fall back on. No dividends, no buybacks, just a chance to make big money someday in the future. Winning businesses, but losing stocks. Sell. No one who owns these stocks seems to care about the out years now. It's much easier to believe that the bright future when you got a bright present. And we don't have that anymore. So what's the end game here? As I've said over and over again, you want to own companies that make real things, do real stuff, turn a profit in the process with relatively cheap stocks and good dividends buybacks. That group has held up much better. It's losing money, but it's held up. Believe me, I know there are some terrific tech companies that fit those parameters. They're all down big today. But there are two major differences. One is that many of the stocks I own for the CNBC Investing Club have a defined downside because of that dividend and their lack of sensitivity to interest rates. Oh, sure, they can overshoot it. But we know they're going to get through. The other reason, they're mature companies that have gotten through recessions before and come out the other side even stronger. They've got the culture for it. They're seasoned. Many of the companies that have come public in the last few years have never seen anything like this. And you know what? It shows. If your stock doesn't have these stalwart qualifications, there's a huge problem. I cannot tell you where the share price stops. I don't know. There seems to be no companies willing to acquire most of the disappointers because the market will look askance at the acquirer. That means there's not a lot of value yet. If interest rates stop going up, you could be fine. But do you really want to be own shares, say, in a company that's hostage to the slings and arrows of the bond market at the beginning of a tightening cycle? Bottom line, there are hundreds of stocks that fit the depiction of what I like. But there are thousands of stocks that fit the depiction of what I don't like. If you own the tangible stocks I've been highlighting, you have an opportunity to buy more into weakness. If you're stuck with the conceptual stocks that I've warned you away from, well, you have a crisis. You know which I prefer. Let's go to Ryan in Texas. Ryan.
Jim, big fan, man. Thanks for taking my call.
Thank you. Thank you for calling in.
Questions about SentinelOne. I know you've had Tomer on the show a couple times, and then they got big competitors like CrowdStrike, and I know you've talked to George a few times. Give me your take on SentinelOne. Is it ever Is it ever going to be a CrowdStrike type stock?
Look, Sentinel, and thank you for the question. Sentinel One, it's a good company, but it's up against CrowdStrike and it's up against Palo Alto Networks. Those are really, really great companies with a good panoply of businesses. And that just may be too tough right now. It just may be too tough. All right, listen, I know this was a really tough day, okay? And I'm trying to be plaintive. I'm trying not to fly off the handle. But you've got to know that if you own tangible stocks, you do have an opportunity to buy more into weakness and have more chance of getting that money back. If you have the conceptual stocks, on the other hand, then I think you are indeed in some trouble, and I'm not sure when that trouble ends. On Mad Money tonight, is innovation alive and well in the Bay Area, and what is it worth? I'm getting a read on e-commerce trends and transformative tech from a company in the know. I've got the CEO of creative powerhouse Adobe. Then after announcing a strategic partnership with self-driving company Waymo, I'm sitting down with the CEO of Uber to talk about innovation and the future for the rideshare company, which I think is going to be the big winner. And Splunk, it's on a mission to manage big data, but can it manage all that Wall Street's throwing at the tech cohort that I just described? I'm going to talk to the company's top brass. So stay with Cramer, coming to you from San Francisco.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.